Hi, welcome back to FinaLit. Today we are going to discuss about derivatives. Before we move into derivatives, it is better to make a brief introduction about investment. We all know that whatever investment, it can be out of saving. There are different types of investment avenues. Bank FD, like a fixed deposit, stock market, mutual funds, NCD, non-convertible debentures, bonds, gold, and real estate, etc. Among these investments, which is the risk-free investment, obviously it is fixed deposit in bank. But if we invest in stock market, although it is high risk category of investment, the probability of getting the return is higher than that of investing in bank FDs and other investment avenues. So, how we can manage the risk and invest in stock market to get higher returns? Where the derivatives comes into the picture. Why do we need derivatives? We can do derivatives for hedging, and we can do derivatives for speculation, and we can do derivatives for arbitrage. Arbitrage is taking advantage of price differential in two different markets. Hedging is a method of reducing of your risk. Then the speculation is nothing but making of a profit out of a underlying asset using a derivative contract. Underlying assets are considered as physical commodities, foreign currencies, financial securities such as shares, bonds, stock market indices, etc. In financial market or commodity market, we all know the prices are fluctuating every day. These fluctuations may be either increase in the price of securities or decrease in the price of securities. And these fluctuations of prices are beyond the control of the individual investor. These fluctuations expose to risk. And how it will affect to an investor? Holder of an asset would suffer loss on decline in prices. Buyers of an asset would suffer loss in rise in prices. Example, if a person holds gold and he needs to sell it after 3 months, he holds the asset with the expectation that the price will increase in future. But when the price declines, he couldn't sell it. Similarly, if a person is planning to buy gold in future for certain purpose, when the price rises, he couldn't buy it by the reserved amount and he has to add additional amount to buy the gold. This is the way the risk arises. So, how we can manage this risk? By entering into derivative contracts. Derivatives are categorized into four, like forwards, futures, options, and swaps. First, we will see what is forwards. Forward is a contract, normally informal contract, which agrees to buy or sell a specific security or an underlying asset at a predetermined price, in other words, lock-in price, on a future date. Example, an exporter exports goods worth $100,000 to USA. Receipt of USD expects after 3 months. Current exchange rate is $1 equal to 74 rupees. Decline in the value of US dollar is anticipated. So, it may fall up to 72, 70, something like that. When the money received after 3 months, there is chance that he may face to loss. So, in order to overcome such loss, he will enter into forward contract with somebody at the rate of 73.5 rupees, so that when the prices declines 72 or 70, he will get 73.5. This is the way a person enters into forward contract. We will move on to futures contract. Futures is exactly same as that of contracts. The only difference is that it is one of the formal contract to buy or sell a specific security or an underlying asset at a predetermined price on a future date. It is more standardized and it can be done only through stock exchange. The stock market acts as an intermediary of the third party in the future contract. Next, options. The word itself means there are options. It is a right. We have option, it is not the obligation, and we have the right either to buy or sell a specific security at a predetermined price on a future date. Next, swaps. Swaps can be explained with the help of an example. There are two persons like X and Y. X applies for a personal loan with Canara Bank branch 1 and Y applies a personal loan with Canara Bank branch 2. X likes to repay the loan with fixed interest rate. Y likes to repay the loan with floating interest rate. But the reverse has happened. Canara Bank branch 1 offers floating interest rate and Canara Bank branch 2 offers fixed interest rate. So both are disappointed. This disappointment can be overcome by entering into a swap contract or swap agreement. Swap is a private agreement between two parties to exchange cash flows, that is, X likes to repay the loan of Y with fixed interest rate as X pays directly to branch 2 and Y likes to repay the loan of X with floating interest rate as Y pays directly to branch 1. This can be possible only if the loan amount is same and the period of duration also be same. This is called swap. So today we discussed about derivatives. Basically there are four types of derivatives. They are forwards, futures, options and swaps. Thank you for watching. Please subscribe, share, like and comment.